The Bank of Canada cut its key interest rate for the first time since March, reducing the benchmark rate by 25 basis points to 2.5%. So that's in line with what was expected. It is the first cut, of course, again since March. So let's get reaction from Robert Kavcic, Senior Economist, Director of Economics for BMO Capital Markets. Thanks for joining us today.
Sure, thanks for having me.
We heard from the governor the reasons why they decided to drop the interest rate. Some of the pressure, he says, on core inflation has diminished. Do you agree with the reasons behind the decision so far?
I think so. I mean, there's a pretty clear trade-off they're trying to make here, right? On the one side, just some lingering pressure on inflation and some certainty about the pass-through of the trade war into Canadian inflation. And on the other hand, just some clear softening of the Canadian economy, whether it's the negative quarter we had in Q2, some below potential growth, some slackening in the labor market. And when you weigh those two sides of the equation, from our perspective, it was pretty clear as well coming into this meeting that the growth risks were exceeding the risk that we're seeing on the inflation front. And in fact, the last inflation number that we got was actually pretty favorable. So I think this was a pretty straightforward call for the Bank of Canada and really didn't surprise anybody.
Do you think it'll be effective to do what they want it to do?
Well, it's certainly going to put some support under the economy, which is ultimately the goal here. Like from a risk management perspective, the Bank of Canada is, if they are looking 6 to 12 months out, there is a risk that this trade war lingers, business confidence is down, hiring is slowed. That gradually continues to grind down the economy. So it kind of makes sense at this point to put a little bit more stimulus out there and get rates back down to the lower end of what they would consider neutral in an environment when inflation is pretty much not quite where they want it, not exactly at the 2% target if we're still seeing run rates at around 2.5%, but pretty close. And I think from that perspective, it doesn't make sense.
How much do you think removing the retaliatory tariffs changed the picture here for the Bank of Canada?
Well, it helps for sure because it's one big source of uncertainty out there on the inflation front, right? And the last thing the Bank of Canada would want was to, let's say, prematurely cut interest rates or cut interest rates to a level that's too stimulative. And at the same time, you start to get pass-through of tariffs into consumer prices, and it gets the wheels of inflation in Canada spinning again. So Ottawa backing down on that takes away quite a bit of uncertainty and frankly, probably gives them a little bit more of a green light to go ahead and cut rates and support growth in the economy.
Do you anticipate from what you heard today that there could be another rate cut? Most are saying at this point, probably not.
Well, so I think the bank was pretty careful today not to tip their hand either way and not to give any explicit guidance that a rate cut's coming at the next meeting. There was a pretty clear bias in the last meeting, in the last round of messaging, that they were on the verge of cutting rates again. They seem to have gone out of their way not to give that message at this point. We are forecasters, though, right? And we're always making judgment calls on these things. And when we're looking at the data flow that's coming now and our forecast for the next 6 to 8 months, from our perspective, the balance of risk does probably suggest we're going to get another 50 basis points of easing. It's not necessarily going to be next month and on a meeting-by-meeting basis, but even if it's on a quarterly basis, I suspect by the time we get to the spring of 2026, we could very well have policy rates down at 2%.
Okay, let's talk about housing for a moment as well, because we saw a very robust August in this country for housing sales. Sort of key markets aside, it was more widespread than that. So I'm just wondering if you think we will see that continue into the fall now that we have a bit of a cut today.
Well, the market's pretty balanced. I think, first of all, it depends where you are in Canada, right? So there's not really such thing as a Canadian housing market at this point. You do have markets that are behaving pretty robustly, so to speak. If it's like in Edmonton or Montreal and Atlantic Canada, you do have markets like Vancouver, Toronto, where are very quiet, and you do have pockets of the market like, let's say, the small Toronto condo market where it's effectively a recession. Okay, so that's the first caveat to this. I think for the next 3 to 6 months as we go through the fall and the winter, given where rates are right now, it's still not enough to get the market really churning again. And I say that from the perspective of an investor. Cap rates and cash flow dynamics don't make sense at 4% borrowing costs. From the perspective of a potential new buyer, affordability is still pretty stretched at 4% borrowing costs. But when we look out to 2026, if the Bank of Canada can actually have room to cut rates another 50 beeps, if we start to get mortgage rates down in, let's say, the 3.25% to 3.5% range, that calculus starts to change a little bit, and I would suspect that that's around a level, assuming the job market holds in, that you start to see buyers come back into the market, and you start to see maybe some bottom-feeding investors start to get a little bit more interested. We're not there yet, but we're going in that direction.
We also have a lot of federal stimulus that they want to support both tariff-affected industries as well as wider new projects. And we have the budget coming out in November. Do you think any of that will have a more immediate or nearer-term effect, that it will be factored into the next decision by the Bank of Canada?
So the October decision obviously is going to be too soon. They're probably going to treat fiscal policy as they did today. By the time we get into December and through the spring, I suspect they'll have a pretty clear outline from the federal budget, how much stimulus is coming and when, and they'll probably build that. Well, for sure, they will build that into their outlook once we get into the December and into the January meetings. Our view is we have a pretty clear rough outline, at least, of what fiscal policy is going to look like in Canada for the next couple of years, and that is it's going to be very stimulative. Probably, 3 to 5 tenths of a percentage point getting added to economic growth in the near term. A little bit depends, of course, on what projects get selected, the timing at which stimulus gets pushed out, how much offset there is from things like the federal government finding savings in the public sector. So it is a case where we really do have to wait to see what the budget numbers look like. But again, as forecasters, I think from our perspective, it's pretty safe to go ahead and assume that we're going to see stimulus start to trickle out more significantly by the time we get that November budget.
Robert Kavcic, appreciate you joining us. Robert, Senior Economist, Director of Economics for BMO Capital Markets.